Welcome back, everyone. Today we have a very special guest, Mr. Wakefield Lee. He is at Meridian, and Meridian focuses on affordable and growing markets in the US. Currently, some of their key markets are in the Midwest. The partnership team has total involvement in 1,500 units across 8 states, with over 150 million in assets under management. The company focuses on creating value in residential communities and aims to deliver a quality living experience to its clients. At Meridian, Wakefield directs the firm's strategic vision, asset management, and acquisitions. With 13 years of experience, he holds a BS and MBA in business administration from the University of Southern California. Okay, that's the mouthful. Wakefield, anything you want to add to your intro there?
Yeah, thanks for that intro, Hugo. And I would just say the people we want to serve are those that are looking to diversify from their current investments into real estate. A lot of people have stocks, but
Yep,
not everyone knows how to add real estate to the portfolio. There's great tax benefits. And I think something for me too is that what are people, going to do for their backup plan, right? For
yep,
their retirement. It's getting harder and harder to plan for that retirement with inflation. And what if something happens in your life? The economy's uncertain, you lose your job, you get laid off.
exactly.
It's
Yep.
happened to me. And for people who, let's say, run a business, have a job, what is their backup plan? So those are some of the things that are important to me and helping people to have a strategy for that. What is the point of all this investment? So that's one of the reasons why I started this and some of the people that I'd like to help serve in real estate.
Okay, okay. Well, it sounds like, yeah, many people can, like you said, many people would love to get into real estate. They just don't know how. So hopefully some people will reach out to you if they want to do that. Okay, so let's jump into some questions. So speaking of real estate, right? How did you first get into real estate? What inspired you? And then like what was the aha moment that made you focus on multifamily?
Yeah. How I got into real estate, as you mentioned just briefly in my bio, I worked in commercial real estate for essentially my career over a decade. I started working in consulting, so I would oversee these portfolios of big real estate projects like BlackRock. Okay, they've got 30 different properties in the West Coast, and what are they all worth? And eventually, I got to a point of how do I get some ownership and how do I get into this myself? So I kind
Yes.
of went down this rabbit hole of, if you know, bigger pockets, big, online community for real estate, and just learned of how to get in for myself. I didn't have all this money, all this big investor dollars, and I wanted to start somewhere. And
Hmm.
multifamily made sense to me because it's pretty straightforward. Everybody needs rental housing. Everyone's probably rented at some point or owned
Yes.
a home and needs to live somewhere. There's such a big shortage of housing, especially in workforce and affordable housing. And
Hmm.
that's how I got into the space of trying to invest myself and figure out how to do that.
Okay, cool, cool. So can you walk us through your first multifamily deal? The good, the bad, and the ugly.
Sure. Our first deal, it took a while. It took a while to get the first deal. But
Okay,
I'm a little bit of background. I'm originally from Southern California, wanted to invest here, but it's very expensive
very
and it's
expensive. Yeah,
hard to
for sure,
get
for
a
sure.
good return in Southern California and other expensive places in the world, like yourself, Hong Kong or
Hmm.
New York, etc. So ran into
Yes.
that problem and researched a lot of markets, eventually found that the Midwest was pretty attractive because you
Hmm.
actually could get cash flow
Exactly.
and then you would have some upside. And that was very appealing to me with not a whole lot of money and just wanted to get started at a reasonable price point that I could afford.
Yep.
And our first deal actually we found on LoopNet, which
Okay.
you might know is just an online database. And
Hmm.
the joke with LoopNet is
Where deals
where
go to
they
die,
Yes,
right?
that's where exactly
Yeah.
deals go to die. It's
Hmm.
like the last place when a broker cannot sell the deal anymore, and he's just gonna blast it out to everybody.
Yeah.
And I didn't know that at first, but then I realized, okay, these numbers look too good, or there's almost always something wrong with with the deal on LoopNet.
Yeah.
But looked for. almost a year, 6 to 9 months, is just trying to study the market and make a lot of cold calls to these brokers. And they're like, we're in California, like stop wasting my time.
Hmm.
And to be fair, I was wasting their time until I found the right deal.
Yeah.
But found our first deal, which was a 28 unit. And for me, just trying to do it myself, it seemed pretty large. But then I compared to LA price and it said, wow, you can't even get a house for this price. So
Yeah.
how is this
Wow.
real?
Okay.
This seems a little bit incredible. I'm talking about years ago, so not
Right.
today. The
Okay. Not
prices
today,
are
but still.
completely different. Yeah.
Yeah.
But still, there was a big gap, and I was shocked. And I said, all right, well, let's give it a try. So that became our first deal, and we grew relationships from there and continued to expand the portfolio. But it was a lot of learning curve. Just okay, how do I manage out of state? How do I buy this thing? And you know, how do I budget properly? What are rents? So big learning curve on that first one.
For sure. So quick follow-up question there. Like, it's like 28 units is usually maybe too small to have like in-house, like a manager, property manager living on site. So yeah, how did you manage to how did you manage that property?
Right. The property actually had managers already who were running it. And
Right.
it's interesting because the people that were running it actually worked for the owner. And the owner
Mm-hmm.
actually, this was his side business. He actually ran a lot of Subway franchises, very
Okay.
successful at that, put some
Yep.
money into real estate. When we took over, we thought, okay, this manager basically it was a couple, a husband and a wife that were managing for them. They seemed to be doing okay.
Mm-hmm.
Now we did that for the first few months and thought, okay, smaller property, we don't need to hire a full management company. And then we started seeing some issues. They're just
Okay.
communication problems, reporting, and there was some tenant drama. So we just started seeing a lot of issues. And coming from my background, I was just used to systems and technology and reporting. And I just really didn't have any of that because they weren't professional managers. And
Right. Right.
from there, that was a big lesson to me as well, is just, okay, we really want to get sort of a more professional manager or management company on site. So we ended
Mm-hmm.
up switching from that company
Okay. Okay.
or
Yeah. All
that
right.
that husband and wife team, basically.
Okay. Makes sense. Makes sense. Hey, if you've got a real estate deal, a problem, or even just a question, we want to hear about it. Doesn't matter if it's big, small, complicated, ugly, or somewhere in between. If it's a good deal, we're absolutely interested. Period. And if you've got capital, you need to put to work in solid real estate opportunities. We've got those too. Either way, let's talk. Here's how this works. We always need more deals. We always need more capital. And we always find a way to make it happen. No games, no runaround. If we can't work together directly, we'll hand deliver you to someone who can. All right. So, how has your strategy evolved since the first deal? So, for example, like deal criteria. Well, let's go one by one. So, deal criteria, has that changed since the first deal?
Deal criteria has changed because the market has changed,
Okay.
right? So we've had to adjust, and initially when we went into this market, we said, wow, we're just is great cash flow day one, and these numbers are really good. But that's, fortunately not the case anymore. The
Hmm.
market's got more competitive, and a lot of people are kind of doing the same model that we started. So
Right.
we are still looking for I'd say under market properties. So if
Hmm.
there is market prices this number, we're trying to buy below that. And
Right.
we're trying to buy basically value add, like a lot of investors.
Yes, yes, yes.
Can
Same.
we
Uh-huh.
operate it better? Can we get some upside? But one thing I'd say that shifted and learning curve was just learning how to do our numbers better,
Okay.
right? So when we first bought that first deal, I said, well, we're just going to keep the rents going as is. Now that was, an okay approach, but now we've learned, okay, we actually should have a more detailed plan. Okay, rents are this, and let's do some market research and figure out how we can get the rents higher.
Hmm.
And not just we're going to increase rents, but probably we need to put some money in as well,
Yep.
right? And you think about it from the tenant perspective, they don't just want their rents to go up, but they like to have a nicer building or nicer amenities or some kind of upgrade and better
Yes,
service, things like that, right? It's got to be a good value proposition for the tenant.
for sure,
So
for sure.
that's kind of shifted over time. And I'd say as we have um, taken on other investors, I think our criteria has gotten more strict. So, before it was just maybe myself, couple people, and
Hmm.
it's a little bit more flexible. But now that we're taking on investor funds, and we treat that as our own funds, and we really want to have a solid plan, make sure we've vetted the deal properly, and been conservative
Hmm.
and
Hmm.
check these numbers by property management and against our operating numbers. So we have much better data, and we're really a lot more selective about our projects now. But the market is competitive, and so we're always sort of at the balance of, hey, should we, you know, sort of stretch our price a little bit or just stay where we're at?
Yeah.
The last thing we want to do is lose money. We'd rather say no to a deal and then say there's a possibility of losing money here.
Yeah, I agree with that. Better to, yeah, it's definitely better to make sure that your price matches like, your projections and so on, rather than trying to go aggressive with your bid and then maybe this deal doesn't turn out the way you want it to. Okay, how about operating and executing? Sorry, I said the wrong question. Yeah, how about risk tolerance? So do you, yeah, I think you've become more conservative.
Yes, yeah. So risk tolerance, I'd say, risk means a lot of things to a lot of people. I would say how we try to mitigate the risk is by being conservative in our numbers,
Hmm.
right? So if and a lot of it comes down to our data and then also the market information that we have, right?
Okay.
So I'll give one example, but if the market rents, we see the top market rent at $1,200. We don't
Hmm.
want to put in our numbers, hey, we're gonna get 1,200.
Right.
I'd like to get maybe an average of maybe the lowest one is 1,000 and the highest one is 1,200. Maybe we'll say we'll get around 1,100, right?
Okay.
Because if my numbers are targeting the top and we don't get to the top, okay, then we're not going to hit our numbers and we're not going to be able to get the returns for investors and
Right.
ourselves. So trying to be conservative and there's, dozens of numbers that we put into our calculations and we try to be, conservative about those.
Hmm.
But on the flip side, we see that there's we'll say, hey, this is what we can expect, but there is some upside, right? Because if we exceed these numbers that we're being conservative with, there is some upside for the investor.
Yeah.
So I'd say, generally we're looking for cash flow pretty soon, within 9 months to a year. We don't
Okay.
want to be negative cash flow for 2 years and do construction on half of the units. So we're not that far into the risk spectrum. I'd say we are looking for a stabilized deal
Hmm.
that is performing, that can get good financing. That's another way we mitigate risk is, hey,
Right.
let me show this to our lender, who's an
Hmm.
objective third party. They don't have any skin in the game. And do they think it can qualify for good financing? So we're
Yeah.
usually looking for 65, 70%. And they're saying, hey, this only qualifies for 40%. Well, maybe that's a red flag to us too, because that means the property's not performing that well either. So that's
Yeah.
another sort of way that we try to balance our risk.
Okay. Okay. That's smart. And has your mindset shifted since the first deal as well?
Mindset shift, I think it's shifting all the time. We're watching the market, and I just lost a deal this past weekend. Somebody paid a lot more than we did. So, sometimes I always think, okay, should I, be a little less conservative on my numbers? But we're gonna lose a lot, unfortunately,
Hmm.
just with our approach. But when we do get our deal, we think it's a pretty good one. We have a lot of conviction in it.
Yeah.
So, I think but I'm always learning, right? So we started with our first deal, and that's been, pretty successful deal, and we really haven't sold any of our deals so far just because they've been performing well. But I
Yeah.
think my mindset has shifted to say, okay, if we're taking on investors, eventually they would like to get their return back. So when
Right.
we'll do our typical 5-year hold, and we've done one of those so far. We just closed on another deal last week, and
Okay.
getting investors for that one. So understanding that we are taking out other people, and being a steward of their funds. Okay, we want to give you guys good reporting and we want to give you a good return and treat, our partners and our investors the right way so we can help them achieve their
Hmm.
goals
Yeah.
and also continue to grow over time. So I think I've been trying to, expand the mindset and think, think more, think bigger, and think a little bit long term and how can we give value to our partners.
Okay, that's good. But I think stick to your, your conservative approach. I don't become aggressive. For sure, for sure. Yeah. Okay, so let's talk about like some tips and pitfalls. Um, Let me see. What are your biggest lessons around finding deals?
Yeah, there's different ways to approach it. Some people will try to find the deals directly themselves, and
Hmm.
some people will go with the marketed deals through brokers, some off market, and some just listed. And we're really looking at most of those approaches. I think the one that we haven't done as much is just direct. We've tried direct approach one time and it sort of yielded the same results as just talking with brokers.
Okay.
So I'd say for us, it's been building those relationships with brokers because that's essentially their job. They've been talking to these owners for 2, 5, 10 years,
Yeah.
and they're always talking to them. So, that's one way we've been able to scale our properties. But, we've even talked to owners directly and tried
Hmm.
to set up some deals that way. So, I don't think there's a magic bullet to it. You just find the deal any way you can. It's competitive. So
Yes. Yeah.
you just have to look through a lot and source, multiple different ways.
Okay. Okay. And how about what are your biggest lessons around operating and executing after you've gotten the deal?
Yeah, yeah. So I've learned a lot here, and in my career, I've been an asset manager. So I've asset managed, 1,000+ units, and I've
Yep.
learned a lot from that career to try to put into our business. And I'd say it starts at the beginning, right?
Hmm.
With like we talked about underwriting, getting your projections right. You want to be conservative there because that's pretty much the business plan, right? You've set
Exactly.
up this
Yeah.
business plan for 5 years, and you want to implement that, right? So year one, where do the rents need to be? Year two, three, what's your growth, right?
Right.
And what are your expenses? So really trying to line up that plan up front and make
Hmm.
that as reasonable, realistic, and conservative, right?
Yeah.
And I think that can kind of set you up for success.
For sure. For
I've
sure.
run into problems where in my career, we have these billion-dollar funds, and it's really the same thing. We say we're going to give you this, and we do, they're happy, and if we don't, they're not happy, right? So
Obviously.
it's
Yeah.
really about setting up that expectation and trying to deliver on that as much as you can. And it's not
Hmm.
easy. It's many, many times easier said than done. So I think just having gone through a few of these has really helped me to refine. Definitely the first time around, we didn't have those systems and processes in place, but we're always trying to make it better. And I think we have a good kind of procedure now for that.
Okay. Okay. And how about like exiting? I think you said you've exited one or two deals, or
Yeah, we actually have not exited our deals so
oh,
far.
okay. Okay. Sorry. Yeah.
They've been mostly joint venture, and the partners have just wanted to hold on. Cash flow,
Okay.
appreciation, refinance. We've had pretty successful refinance, more successful than we anticipated, and that was pretty big win.
Hmm.
But
Did
we
you
in our
manage to pull
deal
out
that
all
we
the
closed,
capital with the refinance, or just some?
we did, yeah, pull it out of the capital.
Then it's perfect.
Yeah,
Then it's
yeah,
perfect.
yeah.
Mhm. To
It's
me, to me
one of
that
those,
to me that to
home.
me that already
Yeah.
counts as an exit. If you get like if you sell and
Mhm.
you get all your capital back, or you refinance and you get all your capital back, I mean that's like that. The refinance is the ideal situation. So that's a big win if you ask me. Yeah.
Yeah, yeah, exactly. So I would consider that a big win. Investors are pretty happy, and we still own the deal.
Hmm.
So that's been pretty successful. But with our project that we had investors on 2 years ago, that should exit in 3 years.
Okay. All right.
But we if we can get to our numbers sooner, we're always watching the market as well. If
Yes.
we can get the same numbers within 4 years or maybe have a refinance and you know gives investors the money back, then we're always, keeping an eye out to see if those are good opportunities to do.
Okay, all right. And what do you think? So, a bonus question really quickly is what do you think is the most effective networking strategy in real estate?
Networking. Can you be more specific? Just networking, like
So,
meeting
okay,
people
so for example,
or
let's talk
events
about
or
with brokers.
Mhm.
You want to get good deal flow coming in from them or something, or even if you're doing direct to seller. So either let's talk about direct to seller or with brokers.
Yeah, direct to seller. Does that mean like you're sending mail or cold calling them
Yeah,
or
sending mail or cold calling.
okay. Yeah, yeah, direct outreach. So, yeah, as I mentioned, we've done one of those strategies,
Hmm.
or we've done that one time, and I'd say I think with either one of them, I'll start with the just the direct to seller. It's
Okay.
about it's about building the relationship,
Yeah.
right? So when if you send a piece of mail or you call them, it's very likely that I mean you could get lucky, right? It just depends, but they probably aren't going to sell on the first call,
For sure. For
right?
sure.
Unless
Yeah.
they're in some kind of distress situation. And I think that tends to happen more with single family. People
Hmm.
might say, hey, actually, I am distressed now and I need help, right? But I think with multifamily, it's more of an investment. And it takes a couple of touch points, right? So you might mail them two, three, five times, maybe once a month, every other month, or it could take, I've even heard, I don't know, a year, maybe 2 years, right? So
Yeah.
you're just continuing to contact them. It can take some time. So I think just, you know, I think not trying to just pitch them. Obviously, you want them to know what your intention is. Hey, I'm looking to acquire properties for,
Right.
and sort of present that. But just understand how you can build a relationship with them, right? Just get to know them and like, hey, what's your relationship with your property? Are you planning to hold it forever? Or just try to understand what their plan is and then be thoughtful with the follow-up and not necessarily, just peppering them every day all the time,
Hmm.
right? So
Yeah.
just kind
Yeah.
of be treat it as I think a relationship. And
Yeah.
I think there's, ways to be successful there.
Okay. Okay. Well, let's go on to the rapid fire round, and so just answer the questions as quickly as you can. Just whatever comes to your mind. Don't think too much. So, how about like your worst tenant story?
Yeah, worst tenant story. Which one? So,
Oh my gosh.
so tenants have
Sounds like
been
you have a lot of
difficult.
them there.
Oh,
Yeah.
there's a lot. Yeah, in this business, you'll run into them. I'd say one, this was not particular with our portfolio, but in my career, I worked on a property in California,
Hmm.
and there's a city where you can't do a criminal check
Okay. That's
on the
so silly.
tenant.
That is so
So
silly. Sorry. Yeah. Okay.
it's extremely silly.
Yeah.
You might have a criminal at your property and you'll never be able to know that. And
Yeah.
during COVID in California, one of the reasons we don't really invest here is COVID said you didn't have to pay, right?
Hmm.
So there's tenants and, it's actually multiple tenants, not just one, but, I've had tenants up to 3 years. They paid no rent in 3 years.
3 years.
Yes.
My goodness. Yeah.
Completely zero. And so
Yeah.
these balances are like 50,000, 60,000. It's mind-boggling. So I'd say, that's a pretty bad one for that I've seen, but one of them.
Okay. Okay. Well, how about your favorite expense saving hack?
Expense as it relates to like property operations,
Yeah.
like
Property
that sort of
operations.
thing.
Yep. Yep. Yep.
Expense saving hack. Hmm. I mean, I think one thing that we do is, some of our properties are actually most of our properties are less than 100 units. So what we
Uh-huh.
do is a portfolio management approach. We don't have a manager at each one of our property sites that are, 30, 40, 50 units because
Hmm.
it doesn't economically make sense.
Definitely.
So one thing we do for us is just say, hey, and this is what we do with our current management company is have a shared resource of, okay, we're just going to manage several properties under the same umbrella. So we don't
Hmm.
have to pay separately, a payroll person for each site. And I think that's led to some savings.
Okay, okay. Yeah, but I think that only works if you have multiple properties in the same market though. But okay, it's fine, it's fine. And do you how about like the most overrated piece of real estate advice?
Overrated.
Yeah.
Um, hmm.
And the follow-up question will be underrated advice as well. So you can well, maybe you can just choose one.
Yeah, okay. Well, I think an overrated one, maybe my interpretation of that might be like it's not exactly true. So
Hmm.
some people say, hey, if you have a great deal, investors will come to you.
I've heard that a
Maybe,
lot. I've heard that a lot.
but
Yeah,
also maybe not. And
yeah,
so I think it's happened to a lot of people of say there's a lot of great deals out there, but that doesn't mean you're going to get investors.
right.
So I've kind of learned that myself the hard way. I think we spend a lot of time trying to find the right deal, but and not like investors just show up and say, I'm interested. So you really have
Hmm.
to, you know, educate and build that relationship before people will look at your great project.
Yeah.
Underrated, underrated. Yeah, I'm not sure. So maybe I'll just leave you with the overrated one.
Okay, that's fine. That's fine. No, no worries. So looking back. Oh no, no. Let me change. Let me go back to the other question. Do you have like because in the Warriors group anyway, everybody likes to talk about their superpower, or as I like to put it, an unfair advantage. What do you think is your unfair advantage or your so-called superpower if you have one?
Yeah, I think for me, it's because I've been in this industry a while. I've done a lot of things, but I'd
Hmm.
say um, sourcing and operations. So, I'm good at, I worked for a broker before, so I know how to talk to them. I know how they
Yep.
think and, how to build a relationship with them and then operating the deal. So I've
Okay.
done asset management and I do it for our portfolio and I think I can help others with that as well, just in terms of, my experience with it. And, I've seen a lot of things that were unsuccessful and, failures from our own investments and
Hmm.
companies that I've worked for. And so
Yes.
I think I can help people with that.
Okay. That's a good advantage to have, I believe. And if you can go back, is there anything that you would do differently?
Anything to do differently? Yeah, I think there's different ways to do this. I'd say, probably partnering up. I think
Hmm.
partnering up just really helps you to scale faster. I was doing this kind of not exactly by myself, but I was sort of the hustle person for
Yep.
many years, and then eventually I joined a group.
Hmm.
So I know we know each other from the Warriors, and I think that's been huge.
Yes.
Just to find the right people, like to your point about superpowers, like, hey, what's your superpower, and how, what are everyone's superpowers, and how can we sort of work together and get a bigger project or scale up.
Yep.
So I think that's probably what I do like much sooner.
Okay. And then the next one is kind of like a two-part question. So what would be your best advice to new investors? And these investors can be, people who actually want to like be the general partners, they want to be involved in the deals actively, or it can be investors that, just they want to invest in deals passively like as a limited partner. What would be like your best advice to those two?
Yeah, so for the GP audience, there's a lot of those folks want to get in to be active. I'd say figure out to your question superpower and
Okay.
find a team that you can help with that superpower.
Hmm.
And then on the investor side, I think it's all about education, right? So there's earlier question, there's lots of great opportunities and everywhere, right? So get educated, know how real estate works, and know what you're looking for, right?
Yep.
If you're looking for better numbers, maybe you want to do a development. If you're looking for something stable, I think multifamily is pretty stable.
Hmm.
But this maybe you want to diversify your portfolio and add in, I don't know, industrial retail, right? So I think it's get educated and learn about the group that you want to work with. I think it's always about the team and the people
Hmm.
over just looking at the deal because numbers, everyone's got great numbers, right? So I
Yep.
think just really working with the team that you think is reliable, that can execute and be consistent and help you achieve what your goals are.
Okay, great. All right. So thank you so much for coming on the podcast today. And if someone wants to, if they want to reach out to you, maybe they want to maybe ask you some questions, they want to invest with you or whatever else, how can they reach you?
Yeah, I'd say you can feel free to email me. So my email is at wakefield at meridianrepartners.com. I don't know
Okay.
if you can drop this in your
Yeah, I will drop
podcast
it on the
somewhere.
screen later on.
Okay. Yeah, and then our website is meridianrepartners.com.
Okay.
If people want to, it's a pretty simple website, but there's a way to outreach and learn a little bit more about us.
Okay, cool, cool, cool. Well, oh, sorry, I should have asked, is there any projects or any resources that you want to share with people, like anything that you're working on right now that might be, that might be of interest, if it's not like, okay, 5 or 6B, obviously.
Yeah, yeah. As I mentioned earlier, we have a project, 35 units in Dayton, Ohio. That's
Hmm.
between Cincinnati and Columbus, and we actually just closed that 2 weeks ago. And we do have one more space for investor who wants to be in a joint venture, not a huge syndication deal, or want to get tax benefits as more active real estate investor, or really just learn about multifamily and being in projects. So people are interested in that. Happy to talk more about it, or can reach out.
Okay, cool. All right. Well, thank you very much and hope to have you back again, to see how you're doing. And thank you very much for your time. And yeah, that's all I want to say. So take care, everyone. Bye bye.
Okay, thanks so much, Hugo, for the opportunity.